Friday is not just another trading day for silver this week. Friday is options expiration. And if you do not understand what that means for how big players move, how prices get managed in the days leading up to that bell, and what tends to happen immediately after expiration clears, you are trading in the dark while the most sophisticated participants in this market are trading with a map. Options expiration in silver is one of the most consistently misunderstood and consistently exploitable dynamics in the entire precious metals space. And this Friday, given everything happening right now with COMEX inventories, the macro environment, and silver's technical positioning, the expiration dynamics deserve more attention than usual. Let's get into exactly what you need to know before Friday arrives. Start with the absolute basics because the foundation matters and skipping it creates confusion later. A silver option is a contract that gives the buyer the right but not the obligation to buy or sell silver at a specific price, called the strike price, on or before a specific date. Call options give the buyer the right to buy silver at the strike price. Put options give the buyer the right to sell silver at the strike price. Every one of those contracts has an expiration date, the moment after which the option ceases to exist and either gets exercised into a futures position or expires worthless. On options expiration Friday, thousands of silver option contracts simultaneously reach that moment of reckoning, and the way big players have positioned themselves in those options and the way they need to manage their risk as expiration approaches creates price dynamics that are predictable in structure even when they are not perfectly predictable in direction. Understanding that structure is what gives informed investors an edge that purely technical or fundamentally focused traders simply do not have. The most important concept to understand heading into silver options expiration is something professional traders call max pain. Max pain is the strike price at which the largest number of outstanding option contracts, both calls and puts combined, would expire worthless. It is the price level at which option sellers who collected premiums when those contracts were written get to keep the maximum amount of premium without having to pay out on winning contracts. The reason max pain matters is that the entities selling options in size large banks, market makers, institutional dealers are not passive participants who simply write contracts and then hope for the best. They actively hedge their option books, and that hedging activity creates real buying and selling pressure in the underlying silver futures market that can push prices toward the max pain level as expiration approaches. This is not a conspiracy theory. It is a mathematical consequence of how options market making works, and it is well documented in academic finance literature across multiple asset classes, including precious metals. When you know where max pain sits for the current silver options expiration, you have a reference point for understanding where price gravitational pull is coming from in the days before Friday. Now let's talk about the mechanics of how that gravitational pull actually operates in practice, because understanding the mechanism is what allows you to use it intelligently rather than being surprised by it. When a market maker sells a call option, say, a call giving the buyer the right to purchase silver at a specific strike, the market maker takes on risk. If silver rallies above that strike, the option moves into the money and the market maker faces a payout. To hedge that risk, the market maker buys silver futures in proportion to the probability that the option will expire in the money. This is called delta hedging. The delta of an option measures how much the option's value changes for a given move in the underlying price, and it ranges from 0 for options far out of the money to 1 for options deep in the money. As silver's price moves, the delta of every outstanding option changes, and market makers must continuously adjust their futures hedges to stay delta neutral. That continuous adjustment process is called dynamic delta hedging, and it is one of the most significant sources of non-fundamental price pressure in the silver market in the days surrounding options expiration. When silver is rising and approaching a heavily populated call strike, market makers who are short those calls must buy more futures to hedge, which adds buying pressure and can accelerate the move toward that strike. When silver is falling toward a heavily populated put strike, market makers short those puts must sell futures to hedge, which adds selling pressure and can accelerate the decline toward that level. This self-reinforcing dynamic is why silver prices often appear to gravitate toward specific levels in the days before expiration. Those levels are not random. They are the strike prices with the heaviest open interest, and the delta hedging flows from options market makers are mechanically pushing prices in those directions. If this framework is reshaping how you think about silver price action around options expiration, please hit that like button and subscribe to this channel right now. This is the level of market mechanics we bring every week, and this community of informed silver investors keeps growing because of exactly this kind of analysis. Let's bring in the concept of gamma and explain why the final hours before options expiration on Friday are the most intense and most volatile part of the entire expiration cycle. Gamma measures the rate at which delta changes as the underlying price moves. Options that are at the money trading right at the strike price have the highest gamma, and gamma increases dramatically as expiration approaches. What this means practically is that in the final hours before the Friday close, options that are near the money become extraordinarily sensitive to silver price movements. A small move in silver's price causes a large and rapid change in the delta of near the money options, which forces market makers to make large and rapid adjustments to their futures hedges. Those large, rapid hedge adjustments create large, rapid price movements which change the delta again, which require more hedging, creating a feedback loop of increasing volatility that experienced traders call the gamma squeeze. This is why silver options expiration Fridays, particularly in the final hour of trading, can produce price moves that seem completely disconnected from any fundamental news or development. There is no news, there is no fundamental catalyst, there is simply the mechanical process of options market makers scrambling to keep their books hedged. As time runs out on thousands of contracts simultaneously, understanding this dynamic means that when you see silver make a sharp, apparently inexplicable move on a Friday afternoon, your first question should not be what news just came out. Your first question should be where options expiration was and whether the price move makes sense in terms of the delta and gamma dynamics of the expiring contracts. Now let's talk about what happens after expiration clears, because the post-expiration period is often as interesting as the expiration itself, and it is an area where informed investors can find genuine opportunity. When options expire, the hedging positions that market makers built up to manage their delta exposure are no longer needed. Those hedges get unwound, bought back if they were short hedges, sold if they were long hedges. This unwinding of hedge positions creates what traders call post-expiration flow. It can move silver's price meaningfully in the hours and sometimes days following expiration Friday. The direction of post-expiration flow depends on how the options expired. If a large number of call options expired in the money, meaning silver's price at expiration was above a heavily populated call strike, the market makers who were short those calls were being forced to maintain significant long futures hedges going into expiration. Once expiration passes and those options are gone, those long futures hedges can be sold. That selling pressure can push silver lower in the immediate post-expiration period, even if the fundamental picture has not changed at all. Conversely, if puts expired worthless because silver held above the put strikes, market makers who had built short futures hedges to manage their put exposure will be unwinding those short hedges, buying back futures, which can create buying pressure after expiration. Reading the post-expiration flow correctly requires knowing how the options book was configured going into expiration, which is exactly what the open interest data and strike distribution data available before Friday gives you the tools to analyze. Let me talk specifically about the big players, the entities whose behavior in the silver options market this week is most worth watching, because not all participants affect price equally, and knowing who is doing what adds crucial context. The primary movers in silver options markets fall into three broad categories. First, commercial hedgers, mining companies, and industrial silver users who use options to hedge their price exposure. A silver mining company might buy put options to protect against a decline in silver prices that would reduce the value of their future production. An industrial user might buy call options to cap the price they will pay for silver they need to purchase in the future. These entities are not speculative. Their options positions are driven by genuine business needs, and their behavior around expiration is relatively predictable. Second, large speculative funds, hedge funds, and managed money accounts that use silver options to express directional views or to implement sophisticated volatility strategies. These entities are more reactive to market conditions, and their behavior around expiration can amplify volatility as they manage or exit positions. Third, the options dealers, the banks and market-making firms that sit in the middle of the options market, writing contracts to both buyers and sellers and managing the resulting risk through dynamic delta hedging. The dealers are the entities whose hedging behavior most directly creates the expiration-driven price dynamics we have been discussing. Their aggregate position, their net delta and gamma exposure across all outstanding silver option contracts is what determines the intensity and direction of expiration week price pressure. This Friday's expiration carries specific characteristics that make it more consequential than a routine monthly expiration, and understanding those characteristics is critical for positioning. The current macro environment with real interest rate dynamics in flux, COMEX registered inventories under pressure, as we discussed in detail in our recent vault analysis videos, and the gold-silver ratio having recently flashed significant signals, has driven elevated options trading activity in silver. Elevated options activity means larger open interest across more strike prices, which means more delta hedging requirements for market makers, which means more mechanical price pressure heading into expiration. Additionally, the proximity of key technical levels in silver's price chart to heavily populated options strikes creates the potential for options-driven price moves to interact with technical momentum, where an options-driven push through a key technical level triggers additional momentum buying or selling from chartists and trend-following algorithms, amplifying the initial options-driven move into something significantly larger. When options mechanics and technical analysis align in the same direction, the price moves that result can be substantially larger than either factor alone would produce. Here is the practical framework for how to navigate silver options expiration week as an investor who is not a professional options trader but wants to use this knowledge to protect and potentially enhance their position. In the days leading up to Friday, be more cautious than usual about chasing silver price moves in either direction. Understand that price action this week is being influenced by delta hedging flows that have nothing to do with fundamental value. A silver price move driven by options market maker hedging is not a signal about silver's intrinsic worth. It is mechanical market plumbing, chasing those moves as if they were fundamental signals leads to buying at expiration-driven highs or selling at expiration-driven lows that reverse once the mechanical pressure dissipates. On Friday itself, the morning session before the expiration close tends to be the most options-influenced part of the day. The volatility in that final pre-expiration window can be extreme and is the period most likely to produce moves that look significant but reverse sharply once expiration clears. Experienced silver traders often reduce their position sizes on expiration Friday morning specifically to avoid being caught in that mechanical volatility after expiration clears from Friday afternoon through Monday of the following week. The options-driven hedging flows have dissipated and price action returns to being driven more purely by fundamental and macro factors. That post-expiration reset is often one of the cleaner, more fundamental-driven trading environments of the month, and it can be a valuable window for establishing or adding to positions based on the actual supply and demand picture rather than the options mechanics that dominated the prior week. There is one more dimension of this Friday's expiration that deserves specific attention: the relationship between options expiration and the physical delivery dynamics we have been tracking so carefully in the COMEX Vault data. Options expiration and futures delivery cycles are related but distinct events in the COMEX silver calendar, and their proximity or overlap can create compounded market complexity. When options expiration falls in close temporal proximity to the active phase of a futures delivery month, which is the case right now with May deliveries ongoing simultaneously, the mechanical flows from options expiration and the physical delivery pressures from the futures market can interact in ways that amplify price moves beyond what either factor alone would produce. A market maker unwinding delta hedges after expiration while simultaneously a commercial entity is scrambling to source registered silver for delivery creates a level of market complexity that even experienced traders find challenging. For retail investors, the key takeaway is simply this: when options expiration and active futures delivery overlap, expect more volatility than usual and be especially wary of reading short-term price moves as fundamental signals during that overlap window. The informed silver investor who walks into this expiration Friday with a clear understanding of max pain levels, delta hedging dynamics, gamma squeeze risk in the final trading hours, post-expiration flow direction, and the interaction with ongoing May delivery pressures, that investor is operating with a map while others are navigating blind. The map does not guarantee a specific outcome. Markets are complex and the interaction of all these forces does not produce perfectly predictable results, but it dramatically improves the quality of the decisions you make during one of the most mechanically complex weeks in the silver trading calendar. Leave a comment below right now and tell us, did you know that options expiration dynamics could move silver prices independent of any fundamental news before watching this video? We want to understand where this community is starting from on options mechanics because your answers shape the depth we go to in future videos on this topic. And if you know someone actively trading silver this week who does not understand the expiration dynamics we just covered, share this video with them immediately. It could save them from making a reactive decision based on options-driven price noise that has nothing to do with where silver is actually heading. We will see you in the next one.